Welcome to the latest in Fitch's series of virtual investor meetings. I'm Kevin Degnan, Global Head of Structured Finance and Covered Bond Ratings. With me today is Huxley Somerville, who heads our North American CMBS rating group. Welcome, Huxley.
Thank you.
I imagine that one of the top questions that investors ask these days, given all the headlines, is with regard to retail, so I'll ask the same. What are you seeing in terms of risks in the retail sector? Is all of the hype regarding malls warranted?
Well, there's certainly been far more store closing in 2017 than in previous years. Causes from bankruptcy of the operator to rationalization of the business plan. We've also seen concerns about Macy's, 2 years now of sales that are down, and that adds to the concerns we also have had for a longer period of time with Sears and JCPenney, all three of those stores being big anchor stores across the country. We're also seeing e-commerce starting to disrupt apparel stores. They've already disrupted electronic and household goods sales, and we expect that disruption will continue over the next few years. But I think it's fair to say that investors are comfortable that bricks and mortar retail won't disappear. The concern is that in CMBS, for want of a better term, you are stuck with the loans you have day one. And they want to know and understand how we at Fitch are analysing retail loans that go into a transaction. And are we fully understanding the potential disruption that may occur going forward. And malls are certainly the prime point of focus. In conduits in CMBS, it's typically B properties, B class malls. A class malls, which are more fortress-like, tend to end up in single asset transactions. And the C class properties, you're already aware that they are poor performers and unlikely to see them in CMBS. So the concern is around how we analyze B-class malls that come into conduit transactions.
Okay, so that's a good segue. Given the risks that you were seeing, how are you treating retail assets in your CMBS analysis?
Well, there are a number of metrics that we look at. Obviously, sales per square foot is a prime one, but we're also looking at the location of the mall, the competition of the mall, where it lies in relationship with its competition, the demographics of the area that the mall is located in. And then at the mall itself, we look very closely at what it's costing a tenant to actually do business in the mall. And that's not just rent. We're also looking at the cost to occupy the space in the form of its contribution towards the upkeep of the mall, security, cleaning, maintenance, etc. And if those costs are higher than 20% of its overall sales, we mark the rent back down so it's in line with 20%. And that means overall less net operating income on a Fitch basis to service debt, and therefore a higher probability of default, all things being equal. Additionally, even if the metrics are good, it's fair to say that today's malls have been underwritten very conservatively. And even in the Fitch model, they may not receive much of an expected loss once we run it through the model. And so if we're uncomfortable or just feel that the metrics don't fully represent the concerns that we have, we also increase the probability of loss to 100%. And in some cases, we've actually limited the AAA proceeds attributed to the loan in the transaction.
Okay. Let's talk about loan types for a second. Are there any trends on CMBS loan types that you're watching closely?
Perhaps the biggest concern is the continued increase in IO loans, interest-only loans. Last year, the 67% had some form of interest-only period in them. This year, that number is 73% to date. Though if you look more carefully at the IO loans, a lot of the increase that is in this year's numbers is due to barbelling of the credit in the transactions. And by that I mean we have a lot of credit opinion loans that have very good credit metrics offsetting poorer quality conduit loans. And the credit opinion loans that are going into transactions are typically what I would call good IO. They start off with low leverage, and if that's what a reward for low leverage, we're quite happy to see IO. The concern is when you have IO on a high LTV loan and the IO is only there because the debt service coverage would otherwise be too punitive for a borrower to maintain.
How about on asset types? Any particular asset types that investors are keen to ask questions on?
One area of focus this year especially has been the number of single tenant office buildings, and investors have been concerned about the number of those, especially properties that are in what can be quite suburban areas. They're typically leased to credit tenants, often multinational companies, and the property serves as their headquarter building. But there is a concern from investors that what if the tenant were to disappear? What is the true value of the property then? Or perhaps what is the risk of takeout financing not fulfilling the full value today because the lease may end 5 years after the current loan term ends? And in our analysis, for any transaction that has properties with tenants that make up 75% or more of a property, we do what we call a dark value analysis that tries to replicate what a prospective purchaser would pay for a property if they had a vacant building and had to spend money to attract tenants, plus the carry costs of holding the investment while they did that. And that, if that limits the AAA proceeds on a loan, then we will reduce the AAA proceeds in the transaction to reflect that reduced amount.
Okay. Finally, let's discuss for a moment volume trends. What's your volume outlook for the conduit and large loan spaces?
Well, as of now, we're right on top of issuance at the same time last year, and we expect that will continue through the end of 2017, plus or minus maybe 2 or 3 billion either side. What we have seen in 2017 is an increased flow in single asset transactions and also Fitch-rated single asset transactions. Mm-hmm. Previously, we have said that the single asset transactions that we'd seen in 2015 and 16 were assets that were B quality but had trophy-like debt proceeds to them, and we were not comfortable rating them. Happy to say in 2017 we are seeing trophy properties with trophy-like debt proceeds, and Fitch is rating those.
Well, that's good to hear. Thank you very much for sharing your perspective with us. If you have any questions about the topics we discussed today, please contact us at the email on the screen. Thanks for watching.